The best lender gets you the lowest rate possible. It's as simple as that. They actually have the fiduciary responsibility to get you the best deal, because if they don't and the rate's higher, the payment's higher, you're going to spend tens of thousands, if not hundreds of thousands of additional interest that you never had to pay, all because you chose the wrong lender. I'm Andrew Russell, owner and founder of RCG Mortgage, three-peat winner. That's right, 3 years in a row winner of NAMBI Broker of the Year, top originator across the country via Scotsman Guide, and just an all-around mortgage gangster. All right, guys, let's tell the story of two best friends, Pixie and Trixie. Pixie and Trixie grew up in Anytown, USA. They went to elementary, then middle, then high school together. Best friends, BFFs, as they say in the hood. They ended up going to the same college, to an amazing school, an Ivy League school. They graduated summa cum laude together, inseparable. They actually invented, and they were 50-50 partners in Dress to Impress. If you know, then you know. And they ended up graduating, meeting the loves of their lives. They both got married. And of course, they decided, hey, let's go back to Anytown, USA and buy a house together on the same block. So you have Pixie and you have Trixie, but they each went to different lenders. They didn't confer together. While one ended up getting a great deal, the other one got hosed just because they chose the wrong lender. So, first one is Pixie. Pixie got pre-approved, applied for a mortgage, which is the money, and wanted to buy a house. Don't judge. Arts and crafts was never my thing, folks. Now, Pixie didn't know who to use for a mortgage, inquired, and of course listened to none other than her mother-in-law. And the know-it-all mother-in-law, of course, said, hey, Pixie, you and your husband, where's all your money parked? Oh, at a big bank? Cool. Reach out to them. Do your pre-approval with the big bank. They're going to be your best bet always. And of course, as every good daughter-in-law does, listened to the mother-in-law, reached out to that lender, did the pre-approval, talked through all the logistics, ended up finding a house, $1 million, put 20% down. We'll talk about the scenario in a second. And ended up using them and only them for the purchase. Didn't shop around, didn't check their reviews, just went with the mother-in-law's advice. Now, Trixie did her pre-approval, but chose to work with a mortgage broker company. That mortgage broker worked with her. Here's the house again, folks. No judgment zone. Worked with her to get her pre-approved and was able to shop the rate around for her on her behalf, which we'll talk about in a little bit, the unique advantage of the mortgage broker. So they both were able to find $1 million house on the same block, live next to each other, which is always their dream. But if we look at both scenarios, they got $1 million sale price for both of them. Similarities and differences, folks. 20% down. So an $800,000 loan, we'll say LA, loan amount. Now, Pixie got a rate of 7% with a 7.25 APR, went direct to her bank, due diligence, didn't check reviews, didn't shop around, went right there and assumed it was the best deal she could get. The payment was $5,600 a month, but then Trixie went to a mortgage broker company. They were to shop the rate around for her. Got a rate of 6%, a 6.25 APR, and the mortgage payment was $4,800 a month. Same type of house, same down payment, same qualifications, but an $800 difference. Now, $800 a month, that's about $10,000 a year. That's about $100,000 after 10 years. That's about $300,000. I mean, you get the idea. As you can see, same scenario. One did the diligence and actually chose the right company to work with, and the other one just straight up got hosed. And I can hear you saying it now, Andrew, this isn't based in reality. This doesn't actually happen. People don't get a 1% rate variance depending on who they work with. It's actually 100% accurate, and sometimes it's even worse. Who you choose to work with on the lending side can be a direct correlation of your success or extreme failure, and in the case of Pixie, hundreds of thousands of dollars lost. There are two major things that you have to be on the lookout for when you choose your lender. Now, the first one, you don't want to be like Pixie. there's a list of red flags. I'm going to give you common questions you should ask that loan officer to make sure none of those red flags are a thing. And the second thing is, will they shop your rate? Now, red flags. Some of the common questions for you to ask are, number one, communication. Will the loan officer, your direct point of contact, will they give you their cell phone number? What are their hours of operation? Are you able to call and to text and all the good stuff? Or are they putting you into the abyss and all you can do is email, which is no bueno, especially in this day and age. So communication is key. We're living in an instant gratification, world and society. So make sure when you work with your loan officer, they give you their cell phone. They're available pretty much 24/7. Obviously, they're allowed to sleep here and there, but that's super important because when you're buying a big asset, a big piece of property, potentially your biggest financial purchase in the next decade, you want to make sure if you have a question, they're there for you. They're able to hold your hand and answer quickly. That's the first thing. The second thing to look out for, the second question is, hey, can I check out some of your online reviews? Now, this could be a red flag. What if there are no reviews? How long's the person been doing a mortgage for? I mean, if you work for a big bank, you can get hired and just get your license like that. Doesn't mean they have a lot of experience. So check them out, Google them, check out that specific individual LO, that loan officer, and check their reviews. Now, of course, listen, does everybody get a bad review here and there? Maybe it's a fake review, of course, but you want something like a 4.8-ish, out of 5-star review, average or higher. You want to check all the reviews, do your diligence on that loan officer and that bank, and see what some of the common feedback are. Are they communicative? Do they know what they're doing? But always make sure you check the reviews. The third question to ask, and it's super important, is, hey, what are your turn times? What's your turn time for pre-approval? Now, the whole process, believe it or not, when you send in your docs, takes like 5-10 minutes, maybe 15. So some places take days and days. It's a red flag. What's your turn time for initial application? What's your turn time for underwriting review? What's your turn time typically from a contract, initial application, to a clear to close? Now, great answers, 3-4 weeks. Very bad answers, I don't have a clue. I just started here, right? So turn time will play a huge role in your success in either buying or refinancing, because the longer it goes, the more stuff happens, the more documents expire, maybe your rate lock expires, and a long, extended, delayed turn time is no bueno. The fourth, of course, super important. Hey, Mr. or Mrs. LO, what are your fees? Now, not all lenders charge the same stuff. Some of them charge nothing. Some charge, we call them junk fees, right? Application, processing, underwriting. Some charge increased fees like origination, just fees that are, we're just charging you this so we can make money off you. The fourth thing to look out for, and it certainly could be a red flag, is when you say, hey, Mr. and Mrs. LO, can I take a look at your fees? Can I get a fee worksheet? Can I know what your fees are going to be? Can I see a loan estimate? Now, not all banks and lenders are created equal. Besides rates, there's different fees. Some of them are standardized, yes, but some fees, number one, we call them junk fees, right? Application, processing, underwriting, commitment fees. That could add up to thousands of dollars. Not all lenders charge those. And of course, points origination fees. Sometimes lenders charge these to make money. So it always makes sense to say, hey, listen, can I take a peek at what your fees are? It's a super regulated industry. You can't lie to somebody once you put it in writing. So make sure you ask, what are your fees? Make sure they show them to you. And if they won't, or they're delayed on, giving you some type of a fee worksheet, it's a huge red flag. So all those things we just went over are super important questions that you have to ask your lender to make sure there's no glaring red flags and you're putting yourself in a bad situation to potentially get ripped off or not even close at all. But the second, the most important piece, the other side of the fence is, will that person, will that loan officer team, that Mr. or Mrs., will they shop the rate for you? Now remember, most people don't realize when you apply for a mortgage, there are 4 types of places you can apply with. That loan officer can work for one of these 4 places, and they're not all the same. The first is an FDIC or a big bank, places that have checking accounts, your savings, all that type of stuff, but they work for that place, and they specialize in whatever that lender offers, and that's it. The second would be a credit union. There's tons of credit unions, right? But it's a little bit different than an FDIC, but it's one of the 4 places that a loan officer could work for. They're usually good at a bunch of things, but not good at all types of mortgages. The third is a mortgage bank. A mortgage bank is someone that closes, funds the loan, but then sells it off, typically right away. But the fourth, the one who can shop your rate for you, is a mortgage broker company. So a mortgage broker company, what they do is they take your scenario. Now, in the case of Pixie and Trixie, it's $1 million house, 20% down. I think both of their scores, if I were to speculate, are probably a 740 or above from a credit score perspective, doing a conventional mortgage. And they can see that mortgage broker company who prices best. Now, how do they do that? They use a cool software called Loan Sifter. So as you can see here, let's kind of walk through this scenario just so you can see exactly how brokers do their thing to get you the best rate. In the case of Pixie and Trixie, Trixie got a rate 1% lower and saved hundreds of thousands in interest just because she worked with a broker who, by the way, used this cool tool I'm about to show you called Loan Sifter. So here goes, right? Here's $1 million sale price with 20% down and a 740 credit score. It's going to say like, hey, what type of property is it? It's going to be a single family home. And let's just do a basic zip code in anywhere USA. And when you finish this all up and press submit, it's going to show you the lowest rate possible with all the lenders the broker works with, which all the best brokers work with all the lenders, of course. So as you can see here, this lender specifically prices the best, and it shows you from the best to the worst. So what this broker would do is it would choose this lender to work with because they're the cheapest, and that's the secret. But as you can see, not all lenders price the same for the scenario. Some are a little bit more expensive. So for instance, if you just went direct to the more expensive company, you wouldn't realize that all these other companies exist. So this is the unique and specific way a mortgage broker can shop your rate with technology and get you the best deal possible and make sure you don't choose the wrong lender and get hosed. So we just went over how to choose the right lender, all the questions to ask to make sure that there are no red flags lurking around the corner, and we showed you how to best shop your rate. But just because you choose the right lender doesn't mean you're working with the right loan officer. There are still ways the loan officer can trick you and potentially get you a bad deal. So make sure you watch our next video. In our next video, we're going to talk about all the ways a loan officer specifically could potentially trick you and get you a bad deal.